Yes. So next on our list is Bloomsbury, and this was it was a full year trading update, and it was those things that Steve and I absolutely hate. I think they should be banned. Just get the results out faster and stop messing me around with these walls of text that don't really say anything. But here is Bloomsbury's full year wall of text update that came out on Thursday. So they said Bloomsbury's trading for the year ended 28th of February is ahead of consensus expectations, and I went and dug them out for you. Consensus expectations are revenue to be 333.4 million and PBT and highlighted items of about 39.6 million. So hard to say where that will land exactly, but 342 million was last year, and that's only 9 million more than just ahead of 333.4 million. That'd mean BMY finishes the year broadly flat on revenue year on year, which I think would be a result, Steve, in a year against a year where we had super growth because there was a Sarah J. Maas release and a back catalogue of 4 more books to buy. But crucially, they'll be more profitable than last year. So meaning the PE will drop back to the sort of 12 to 15 kind of mark. I'm giving you a range there because I don't really know where this is going to land. They said the acquisition of Roman and Littlefield, which they did in May 2024. The integration of that is progressing very well. It drove growth in the non-consumer division. Bloomsbury Digital Resources grew for the full year despite budgetary pressures, highlighted in the interim results, and they grew in core academic markets as well. They said that the strong performance and associated cash generation with this strong performance has actually enabled them to pay down 7.5 million of the 37 million debt that they're associated with the acquisition of Roman and Littlefield way ahead of schedule. So they only acquired it in May. Results are that good. They paid down 7.5 million of it already. They said that the company's robust performance is powerfully driven by the determined execution of Bloomsbury 2030, which is what we spoke about, I think, probably the last 2 times we've covered this. But it's basically focusing on growth, portfolio, and people. Authors, customers, consistent performance, and scale will give the business a bit more resilience and underpin sort of the confidence I have it growing into the future. Preliminary results will be out the sort of 22nd of May. Also, new board member, Dame Heather Rabbits. She's coming into the board as non-executive director from the 14th of April. She's going to be a member of the audit, remuneration and nomination committees. She's already an independent director at ABF, Associated British Foods, M&C Saatchi Group, and also was a non-exec at Kia Group as well, the building outfit. So much of Bloomsbury's growth hinges on the Akatar series, which is what it's called, a core of Thorn and Roses. Sarah J. Maas has promised she's already working on the new book, and there'll be a new one within the next 18 months if the previous schedule of the last 5 books continues, because we've had one in 2015, 2016, 2017, 2019, 2021. I would say we must be very close to this new book. I think this is attractive at this kind of price, Steve. I said I was talking to Tom's personal finance the other day, and I said to him, "Oh, it's close. You know, it's on the list of things I could go and buy some more of." Steve, what do you think?
I was going to say it must be back at the kind of multiple where you were buying it before, although not the kind of price, because, as you point out, revenues have gone up quite a lot since then, and profits have gone up quite a lot since then, and now we're back at the right kind of multiple. When you managed to buy it before, when it was about to kind of make a step up, effectively, and we're now kind of post that step up and working out partly what the next thing is and partly how we hang in at this kind of level. And there's good stuff to come, as you point out. This has been, to some extent, it's not been the Sarah J. Maas show. That's probably too strong, but she's been a very important part of the growth story over the last few years. I think you've told me that you personally are quite a fan of her work, or the stuff that you've read. Okay, you've read it.
I read it. It's fine. I can understand why people like it. Is it totally my thing? Not sure, but I read it in sort of 2 days and 3 sittings, Steve. So maybe I enjoyed it a lot more than I'm giving it credit for. I would read the other things in the series. I don't know. I wanted to know how it finished, but I wouldn't say I was like desperate to know how it finished. I mean, if you took the book off me and burned it, I would have been upset. Because I was 2/3 of the way through and I couldn't really it's one of those kind of books where you think, okay, well, this is easy, everything's going to go well, and I can't really see how we lose here. And then there's sort of a twist and turn in the last third of the book, and you think, okay, there's absolutely no way we win here. And then the heroine, the lady, finds a way to win when you'd expect her not to. So yes, I mean, I can see why people like it. It's like I think it's a bit Game of Thronesy, but kind of aimed more at women, and you can see why that has an appeal.
Steve D there doing his job for the Times Literary Supplement. Meanwhile, Rowman and Littlefield, as an academic publisher, I'm based on what I know about academic publishing, which is quite a bit, but quite a bit in a fairly niche area, which is mostly philosophy. I tend to think that this is a good thing for Rowman. There's more books written than need to get written, and that means that someone got to publish these things, and they are, philosophy-wise, they're not top two. Those are the university presses at Oxford and Cambridge. And they have quite big capacity to publish stuff, but they can't publish everything. And below that, you sort of get Rowman, and you get Routledge, and you get several other things as well. And they're all kind of fine. I say this as a book with someone with a book published by one of those. They're fine, they're good, they're respectable. They're also, people know that you didn't publish that through OUP or CUP. Mostly OUP in philosophy. And so I think this is a trend that's likely to be fairly durable here. I think there's going to be more people wanting to write philosophy books, and indeed academic books more generally, because that's how you advance your career, and they can be quite attractive careers. As you can tell, mine's going incredibly well, which is why I'm making podcasts on the side of it. But on top of that, I think there will be a long kind of pipeline of stuff coming out, which they will sell to libraries, because libraries will buy sort of most things, despite the fact that they only have finite amounts of space, but they will sell online access to these things, and libraries will be like, great, we have more money than we have room. We can't fit too many more physical books in our building, but we will absolutely pay you any amount for a recurring subscription to your kind of catalogue of things. And this could be a nice kind of model for everybody. People write for you, people review for you. You don't have to pay basically any of them. They typically do pay reviewers at this kind of level, not in journals, but in books. And from there, we kind of get what could be a nice business from a kind of commercial perspective, regardless of what you think of it as being top or middle kind of academic tier. So I think that could be a smart acquisition. And I sort of think of paying down debt and getting the margins straight and so on as basically part of the integration process. It's not necessarily the kind of operations integration process, but it's an important part of getting to the stage where we're realizing the benefit. And it's good to see them paying that down ahead of time, I think.
Yeah, I saw it as a largely positive move, Steve. I think it was there to kind of say, this has been a good year again for us, and look, this is how good it's been. We're going to do this. So yes, I took it as largely a positive. But again, it's a no number trading release. Really, it's one of those where it says we take the consensus and we're higher than it. And if you were to ask the question how high, they'd say a bit. And they've done this before. But I mean, they've constantly beaten expectations. Though, Steve, since I've owned it, they have been. They don't beat and raise because there's no real guidance, but they've been constantly beating what the analysts have expected of them. And I think this might be another year of it. They promised a flat year, maybe a slightly down year. So if we get a flat year and not a slightly down year, that's a real positive moving into a sixth book in the Sarah J. Maas series. So I mean, if we get the kind of traction that we had for the fifth book, then you should see a fairly decent jump in sales. And then all the other things, because Bloomsbury, it's not just a one book show. Obviously, they were a Harry Potter publisher back in the day. They're still publishing different versions of Harry Potter books. But there are lots of other really popular authors as well, and cookbooks and things like that in there. So yes, I'm largely happy with Bloomsbury, and yes, I think I could buy some more. I was just looking at the share price, Steve. Year to date, we're down 11%, really, on no news whatsoever. 6 monther, we're down 12%. So it's not been a great 6 months for Ronnie Bloomsbury. It got up to 750p. We're now back down to just under 600p. So it's been lower. We'll see where we go. I think I could add to it though, Steve.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.